Good morning, and thank you all for joining. Today, we have a very specific and very relatable webinar, which is understanding your options with your non active retirement plans once you've left your former employer. And if you're on the call, you've probably had or have a non active 401k, 403b, or just some type of retirement plan that you're no longer contributing to, and it may just be sitting out there. So, for today, what we're going to do is spend a lot of our time discussing what options you have with those accounts, strategies available to you within those accounts, and potentially next steps. However, before we begin, as always, let me give you a quick overview of my team. But first, as always, a quick disclosure from compliance, and we will be talking about some tax related information. So, as always, be certain to review any tax strategies with your CPA or tax advisors. But on to us. We are a boutique wealth management and financial planning firm here in beautiful Irvine, California. However, we do have clients across the entire nation. And what we do with our clients, many of which are on the line, is to work with them on their holistic financial planning and investment management needs. We found that our industry is just a little too focused on just the investment side of planning. So we've made it a priority to take a comprehensive and to take a holistic approach to planning and to continuously educate, which is one of the reasons why we host this webinar series, among others. Now, our financial planning process involves building a well designed financial plan, organizing our clients' investments in coordination with their plan, and then just ensuring that any outside financial planning items have been handled, which may or may not involve our collaboration with CPAs, attorneys, or just other professionals that may be within our client's advisory team. And here's a quick overview of our team. Within our firm, we have 7 advisors, a retirement plan specialist, an investment specialist, and then 3 administrative assistants. But enough about us, let's get into today's topic. And during this series, what we do is we hit on many of the topics within the planning pyramid, which, when properly planned for, can help you have a more fulfilled life and a more stress free financial life. And for today's topic, what we're going to do is hit on 3 areas of the planning pyramid, which are retirement, asset allocation, and organization and control. And for today's agenda, what we're going to do is review 5 main items. First, I want to spend some time reviewing 401ks and retirement plans in general. Second, I'll be discussing options that you have within those accounts once you are no longer employed with that company that housed that retirement plan. And just as important as your options, though, are the advantages and the disadvantages to the options. So we'll be discussing that as well. The fourth item we'll be discussing are strategies that you have available if you decide if you decide to move your money from an employer plan to an individual retirement plan, and we'll get to that. And then lastly, we'll discuss next steps that you should be considering as you plan and move forward. So with that being said, let's begin with what exactly an employer-based retirement plan is. And the first thing to understand is that an employer retirement plan is what's considered a tax advantage investment account or tax advantaged investment account. The plan itself is not the investment. It's just an investment vehicle that has tax benefits associated to it. For example, think of a retirement account as a big bubble. And within that bubble, you have various investment options. For example, stocks, bonds, mutual funds, ETFs, and so on. The investments are the things that grow and will hopefully grow and hopefully make you money. And that bubble is just the retirement account. And because it is tax advantaged, you don't have to deal with taxes on any gains or investments that are created due to the investments within. Things that would typically cause you tax, like dividends, interest, or even capital gains, they just stay within that bubble. And those taxes are deferred into the future when you ultimately distribute from the account. Or in the case of a Roth account, as long as it's a qualified distribution, you never have to pay any taxes. Now, these plans, while employed, typically will automatically invest for you, usually via a payroll deductions. These plans could be a 401k, a 403b, a thrift savings plan, or maybe a 457 plan, or even a stock ownership plan or something else. But these plans all do the same thing. And what they do is they usually save you money in taxes and hopefully postpone taxes into the future, which keeps more money in your pocket instead of the IRS's. And of course, Roth accounts, you pay the tax now, and you don't have to pay tax in the future. And often, these plans could be a traditional employer plan, or as I mentioned, a Roth employer plan. I won't go into the details of that all because it's not too applicable for today's conversation. So just moving on, these plans are typically then managed by what's called a group employer-based plan. And essentially what that means is your money is, think of it as somewhat grouped together with a lot of investors' money within that company plan. And then you can select your specific investment options that the plan then allows for. Now, typically, there are a variety of investment options within the plan. However, you're usually limited compared to some investment vehicles, and we're going to talk about that shortly. But in summary, these plans are a retirement savings vehicle that is offered through work. Because they're tied to your payroll, it's usually fairly easy to invest into one of them. But what's important to know is that once you are no longer employed with that company, you can no longer invest more money into that one plan. So it's essentially what we call a static plan. And you then have the ability to potentially move those funds into different types of plans, which leads me to the next section in the next slide, which is where I'm going to discuss the four options available to you once you are no longer employed with your employer. And to summarize, you do have four options. First, you can leave the money alone in most cases, which means you're just leaving your money with your former employer retirement plan and not touching it. You can still change the investments and adjust it, but usually you can't contribute to it, and you're only allowed to invest in whatever options they have for you. Secondly, if you wanted, you could liquidate the plan and distribute the cash. Now, in most cases, though, this is about the worst thing that you can do. We'll talk about that in a second. But in some cases, it's just necessary or quite frankly convenient. The third option is that you can move into, move the money into a new employer plan if you are no longer working at that company, but have a new 401k plan at a new company. Remember, the plan itself is just a means to invest efficiently for retirement. So you can always move around the funds so long as they stay within the retirement account, and that's how you defer taxes in most cases. And that leads me to then the fourth option, which is that you can move the money to what's called an individual retirement account that you just manage yourself. Now, in my opinion, this is one of the most efficient ways to invest. However, there are issues that could arise in all four of these cases, as well as benefits associated to each. So, what I want to do now is get into the advantages and the disadvantages of all four options so that you make a smart financial decision given your specific situation. And with the first option, which is leaving your plan as is, not doing anything with it, it has the most upfront benefits, I'd say, which are that you maintain the tax efficiency of leaving your funds in a retirement account and you don't have any more work to do. And quite frankly, it's just simple. There's nothing wrong whatsoever with just leaving your 401k where it currently is. However, there are some disadvantages that you should be aware of. First, on average, Americans receive a new job about every 4 years. And that means that over the course of your working years, you have a lot of retirement accounts build up. Because of this, it's very easy to lose track. Secondly, with 401ks and group retirement plans, many times you have very limited investment options. The third issue is that sometimes you experience poor communication with the plan administrator because it's a group plan and you have to deal with the plan administrator in a lot of cases when accessing your money. And that can result in long wait times on the hold or just delays in getting you the cash that you're trying to pull. And lastly, in my opinion, which is probably the biggest issue, is that there are uncontrollable internal expenses to 401ks. Now, that's just one example. There are many 401ks with low expenses. There are many 401ks with high expenses. What's important is you just understand the expenses to your plan so you make a smart decision given your investments. But all in all, it may make sense to leave your plan as is, but there are other options. So let's move on from the first, go to the second, which is that you could liquidate your plan. Now, this is essentially taking all of the cash out of your retirement account and then putting it into your bank account. Now, the advantage to that is that you have access now to the cash that you've saved for retirement, and it does reduce the number of accounts you have to manage. However, the disadvantages are that you potentially are going to be assessed income tax on the distribution, and you also may have to pay an early withdrawal penalty of 10%, and you're permanently reducing your retirement savings. Generally speaking, I usually never recommend this option unless the situation truly calls for it and you need the cash. So with that being said, let's move on to option three, which is that you could transfer your old plan into a new plan. Now, this essentially involves informing your former retirement plan provider that you would like to cash out the account and have the funds sent to a new qualified plan. And because you technically aren't distributing the funds, you are rolling over the funds, then you don't have to pay tax or penalty like in the last example, so long as you do it correctly. So the benefits are you have no tax. You continue to defer those taxes. You are consolidating accounts, which allows for ease of management. And then you also have potentially the option to take a loan from your new 401k if you needed to take a loan. Because in most cases, you're not allowed to borrow money from a non-active 401k plan, but you can, in most cases, borrow up to $50,000 or the lesser of $50,000 or 50% of the account balance. So in a situation where you move old funds to a new plan, you might be able to take a significant loan from it. There are disadvantages to this option, though, which are that one, it does take work to transfer the money. And generally speaking, there's information you need to prepare, paperwork that you need to have sent in, checks deposited, and there are more steps involved. We'll talk about this later. And additionally, just like the first option of leaving your money in the current plan, you do still have limited investment options within a group plan usually. And there are some uncontrollable internal expenses, which in some cases are very high. And lastly, when you do a rollover from a group plan to another group plan, usually it's irreversible. So once you decide to do it, your investments are generally somewhat stuck until you leave your job. And now that plan is also a static plan. But overall, this is a great option for someone who wants to consolidate their accounts for ease of management and simplicity, but also doesn't feel comfortable moving to an individual retirement account and managing it themselves. And that is the last option I want to talk about. And generally speaking, this option does have a lot of benefits. However, it requires the most work on your end or your advisors if you work with someone like myself. And the advantages are as follows. First, you don't have taxes or penalties to moving the money into an IRA because the money stays within that tax bubble I spoke about. There aren't any fees or taxes assessed to you. Secondly, you still maintain the tax deferred nature of that plan. Additionally, just like consolidating into a current employer plan, you can consolidate a bunch of 401ks into one IRA and have that ease of management and less stress involved with monitoring a bunch of accounts. The biggest advantage, though, in my opinion, is that you get now full control of your assets, which means that you get a pick from the world of investments what exactly you want to invest in. Now, we'll talk about this in a bit, but you could invest in a well diversified portfolio into stocks that you think could appreciate in value, ETFs, mutual funds, or bonds, you name it. The choice is yours. And with this, you now control the costs involved with investing. So rather than investing in some, potentially high expense fund within a 401k, you can choose from a much cheaper option within an IRA and ultimately save you more money. And additionally, you do have some creative strategies within these types of plans that could result in some more money made through investments or through certain tax savings. But of course, there are disadvantages, which really are two. And the first is there is work required to transfer the money into an IRA. It's not the easiest process. And secondly, there is work required to research investments, unless, of course, you work with an advisor. And for some, the disadvantages are large enough to push you in the direction of another option. However, for others, the cost savings and potentially the enhanced investment options and consolidations are worth the time to follow the process. Just ensure that you're really thinking through all of your options, all of your benefits, and all of your negatives before executing on one of these strategies. So, with all of that being said, what I'm going to do now is I want to spend some time reviewing some of the specifics to the last option, as it is the most complicated and it's what I have the most expertise over as a financial planner that works with IRAs. So let's just jump right into it. So the second part of today's conversation is just going to be some of the strategies you may want to consider if you do decide to move your money to an IRA. And then lastly, we'll discuss what the process may look like so you can be fully prepared to implement it for yourself if this is the route you decide to go. And to start, I want to take a step back and explain the concept around the efficient frontier because it plays into exactly what I mentioned earlier around efficient investing, potentially within an IRA. And generally, what this concept is the idea that for whatever risk you are, maybe you are a high risk investor or a low risk investor, there is an optimal rate of return that you could target through proper diversification of varied asset classes available to you in the open market, some of which may not be available in a 401k. And in summary, what this methodology says is that no one asset class is truly efficient. Excuse me. No one asset class is efficient, and really to receive a optimal rate of return, you do have to be invested in all these asset classes in proportion to your desired risk tolerance. Now, shown here are not all the available asset classes. This is just for illustration purposes, but it serves a purpose to show you that, let's just say you're a mid-range investor. You aren't just going to be invested in asset classes that are middle of the pack. You may be invested in, some of those, but you're also going to be invested in some of the more risky as well as some of the more conservative, but to the specific proportion to the risk tolerance that you are comfortable for or comfortable with. And the reason this is the case is because of diversification. Different asset classes move differently with varied market environments. And by having more things that move differently with one another just means less volatility. And what the efficient frontier says is that there is an optimal mix of these varied asset classes. And to improve your rate of return without taking on any risk, you might be able to implement something along these lines. It's more or less like a recipe for investing. And to give you an idea of how this looks when we do our analysis, in many times, certain asset classes are just completely missing from a well-diversified portfolio report. Now, what I'm showing you here is actually a screenshot of a recent analysis we did of a 401k target fund. And what you can see is the breakdown of the asset classes within the account versus what we would consider a well-balanced portfolio utilizing this methodology. Now, the red lines being the 401k and the blue lines being the well-diversified portfolio. And as I mentioned, 401ks and many employer plans, they might have anywhere from 20 to 50 investment options. But within an IRA, you have thousands in most cases. And that just means that you can potentially fill your, call it your investment pie, with a little more sophistication and a little more diversification. Ultimately, there are just some asset classes that employer retirement plans don't offer. For example, sometimes high yield bonds and real estates can be hard to come by in an employer plan. And sometimes alternative asset classes like alpha opportunistic or absolute return. So if you decide to move your money into an IRA, just know that you have the world of investments at your fingerprints, and generally it pays to diversify. But I'm going to leave it at that and move on to the next strategy you have within your IRAs, which are Roth conversions. And for this strategy to make sense, I need you to understand the difference between a traditional retirement account and a Roth retirement account. And with a traditional retirement account, you receive a tax deduction for every dollar that you put into the account. Now, that money is going to grow tax-free, and when you have to withdraw the money, you pay ordinary income taxes. With a Roth retirement account, you do not receive a tax deduction on your taxes in the year you contribute, which means you don't save on taxes upon contributing. But when you take the money out in retirement, so long as it is a qualified distribution, those funds are going to be tax-free. I mentioned this concept earlier as well. So generally speaking, for high income earners, people in the high income tax bracket, they like to contribute to a traditional retirement account because they save money now in tax via tax deduction. And for those that are in a low tax bracket, they usually like Roth retirement accounts because they pay taxes when they're in a low tax bracket and they never have to deal with the taxes ever again. But what most people don't know, and this is where I'm getting into the strategy, is that you can actually move money from a traditional retirement account to a Roth retirement account. And when you move money, it's not considered a contribution, it's considered a conversion. And that is the strategy that I want to talk about. So, the process for a Roth conversion is you first have money in a pre taxed investment and vehicle, and often it's easiest to have the money in an IRA account. Second, you convert the money or a portion of that account to a Roth based retirement account, usually a Roth IRA. Now, when you make the conversion, you pay income tax on the amount that you converted. But the benefits is now your IRA money is in an after tax account, so you never have to pay tax on this again. But you should be asking yourself this: why would I want to convert if the whole purpose of putting my money in a traditional retirement account was to postpone taxes to the future? Well, the answer is quite frankly very simple. Maybe things have changed for you financially. And now you might be in a lower tax bracket, and maybe it makes sense for you to prepay to your taxes today so that you can pay a lower percentage today and never have to deal with the taxes ever again. And I think this example really can be explained and best illustrated by showing you this chart or this slide. Maybe you have $30,000 in an IRA. You let those funds grow for 10 years and they double, and then you're sitting with $60,000. And then at that point, let's say you decide to distribute the money, and at that point, you're going to pay maybe 30% tax. Well, at that time, you'd have to pay $18,000 of income tax, yielding you a true value of only $42,000. So that $60,000 IRA, not really worth it. It's worth $42,000. So let's change the scenario here. Let's say you have $30,000 in an IRA, and right now you're in a fairly low tax bracket. Let's just say you're in transition, you're not working, and for this year you're only going to pay maybe 15% in taxes. So for this illustration, you're going to pay 15% tax. And let's say you decided to convert that money and pay the tax. Well, your account would go from 30,000 to 25,500 today because you're paying 15% in tax and it's coming out of that account. And then, just like the last example, your investments did well and they double over 10 years. Well, now at this point, your account would be valued at $51,000. Now, the difference between these two scenarios is that your Roth account is never going to be taxed because it was taxed on the front end, so long as the distributions are qualified, of course. So that $51,000 is truly worth $51,000. In the example above, the $60,000 is really only worth $42,000. So in this example, strategically paying tax ahead of time actually made this person more money. I've executed this strategy myself and for clients, and when it makes sense, it can be a very strategic long-term planning move. In summary, though, if you're in a low tax bracket now, it may make sense to convert some of your IRA or 401k or pre-tax retirement funds if you think you're going to be in a high tax bracket or a higher tax bracket in the future. But enough about conversions because I do an entire webinar over those, so just join me for that. Let's talk about the last thing that I wanted to talk about, or the second to last thing, which is that if you have an IRA, you may actually be able to contribute to them and receive even more of a tax write-off if you have one open. So let me show you this chart. And what I'm showing you here is the 2022 and 2023 chart for deductions available if you have an IRA account. What this shows you is you may be able to invest more money into an IRA, potentially even if you already have an active 401k. And by contributing, you'll save more for retirement and potentially save more today in tax. Additionally, if you're no longer working, let's say you're a stay-at-home spouse, you may also be able to make a spousal IRA contribution, which ultimately improves your household money for retirement accounts and saves your household money and taxes. Ultimately, if you have available cash and you have the means to make a retirement contribution, then typically, and this is a general rule of thumb, it makes sense to do so. And if you can kill two birds with one stone and also consolidate old, IRAs or non-active retirement accounts into one IRA, in many situations, it pays to do so. It's like spring cleaning for your investment accounts. So with that being said, let me explain the rollover process if you decided that is the best for you and for your planning. So let's talk about that now before we close off. First off, if you decided to roll over your 401ks or old retirement plans into one IRA, you first need to find out if your old plan is pre-taxed or post-tax. If it's post-tax, it's usually going to be a Roth plan, and sometimes it's both. This determines if you need to open up a traditional IRA, a Roth IRA, or both to roll those funds into. And that leads me to the second step, which is opening an outside IRA or Roth IRA with a new financial institution. Once those accounts are open, you'll then need to contact your prior retirement plan administrators to do what's called a qualified rollover. Now, this is a non-taxable event when done correctly, and it allows you to essentially keep your money within that tax bubble that we spoke of. But once you're on the phone with them, you'll need to provide the plan administrator with your new account numbers or number if it's just one account, and your new financial institution's name and address. They'll send the check to either you or the financial institution directly. And if they send it to you, you will need to forward it along to the new financial institution. And then once it's deposited, you then go ahead and reinvest those funds. And in summary, here's everything that you'll need to do in preparation for that call with your former employer plan. You'll want to have your investment strategy decided so that when it comes time to invest, there are no questions or hesitations. You'll need the IRA accounts to be open so that the employer plan has a destination for the check, and that involves knowing the exact account numbers as well as the address for the new institution. And lastly, you will need to know what number to contact for your former plan administrator. This usually can be found on your statement or you can contact HR. But I'm sure this process has raised some questions. So if you have any, feel free to contact me directly. If you're curious and want to talk to us about what it would look like working with an advisor and assisting with some of these items, we'd be more than happy to help. And for clients on the line, if you have questions, always reach out. Our door is always open. But what I'm going to do now is open it up to questions. So for those on the line, you can raise your hand at the bottom of your screen and I'll open one by one. And for those watching the recording, I do have to end it prior to our Q&A. So if you have any questions, please reach out directly to me. But thanks for joining, and I'm going to close out now and then open it up to questions.